Yes, good morning, everyone, and thank you for having me on the show again. It's all about capital strength. I mean, we are a bridge over troubled water in, let's say, a very rocky half year in the financial markets, one of the most volatile financial markets and the worst start of the year in 50 years for investors. And that is, I think, proof testament to the strategy that we set ourselves out to do a couple of years ago when I joined as CEO. Which to ensure that the company is strong in volatile environments. And today we're showing that. And as a result, we are able to raise our capital outlooks for both this year in operating capital generation, but also for the 3-year target for next year with that minimum $2 billion of free cash flow to be generated. The quarter also saw that our operating result was good and held up well in these volatile environments. Our sales growth in the chosen areas has continued, although asset-based sales have obviously been affected by the lower equity values and the lower bond values. On the net result, we're seeing the effectiveness of our hedge program come through, but also the volatility of the financial markets, because the net result has been impacted by 3 things. First of all, by an accounting noise, I would say, which has to do with the fair value measurement of assets and liabilities of our large hedge platform, which has performed very well, 98% hedge effectiveness, which has protected capital very well. Then the second one is an assumption update review we always do in the second quarter of the year. That is a non-economic and non-cash item as well. And finally, we had to take a charge for reinsurance as reinsurance rates have gone up for a specific book in the U.S. to $200 million.
Lard, as we talk about some of the market uncertainty, we're still setting up for some wildcard data releases. We just had the inflation number to digest out of the States overnight. How much more volatility do you think we're going to have to weather? What sort of quarterly change are you looking at this stage?
We have seen a lot of volatility in the last half year driven by geopolitical unrest, driven by higher energy prices, inflation, of course, globally, and, still the disruption of supply chains post-COVID. We believe that central banks are, of course, fighting hard against inflation as much as they can. We're seeing labor markets in the Western world strong, but at the same time, we expect bursts of volatility to maintain. I mean, this is not over anytime soon. So what is very important is that we run our models and that we keep adjusting our balance sheet to ensure that at all times and in all scenarios our clients' money is safe to us.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.